the tone.
Good afternoon to our audience. Thank you for joining us today. We have a very interesting webinar that we're presenting in conjunction with the Treasury Department. The name of our webinar today is the Consolidated Appropriations Act of 2021, and in particular, the Emergency Capital Investment Program, or ECIP. My name is Catherine Baxter. I'm your moderator for today's event. Before we start our webinar, let's go over a few housekeeping items. So please adjust your volume on your computer so that you can hear this webinar clearly. You may resize the slides on your screen by dragging that bottom right corner. From this website, you will need to allow pop-ups. There's an Ask a Question feature on the left-hand side of your console. Please use that to ask questions to our speakers at will. We prefer that you ask questions throughout the webinar. Don't wait until the end because we'd like to entertain your questions as soon as we can once we're done with the presentation. And as always, in approximately 3 weeks, this webinar will be closed captioned for on-demand viewing in NCUA's Learning Management System. Now, before I introduce our next speaker, Myra Tappy, I'm going to read a disclaimer that we have. And it says, the materials presented in this webinar are intended as an informative and educational summary of general information related to the Emergency Capital Investment Program, ECIP. The NCUA has taken reasonable measures to ensure the quality of the data and other information produced by the NCUA that is available in this presentation. The NCUA, however, makes no warranty, express or implied, nor assumes any legal liability or responsibility for the accuracy, correctness, or completeness of any information that is available through this presentation, nor represents that its use would not infringe on privately owned rights. The slides are intended for educational and discussion purposes and do not constitute legal advice, nor replace independent professional judgment. Reference to any specific commercial product, process, or service by trade name, trademark, manufacturer, or otherwise does not constitute an endorsement, recommendation, or favoring by the U.S. government or the NCUA. So at this point, I'd like to introduce our first speaker, who is Myra Tappy. She's the Director of the Office of Examination and Insurance, and she's going to introduce the rest of our program. Myra, please.
All right. Good afternoon, everyone. Thank you, Catherine. This is Myra Tappy, the Director of the Office of Examination and Insurance. Welcome to the NCUA's webinar on the Emergency Capital Investment Program, also known as ECIP. Established by the 2021 Consolidated Appropriations Act, the ECIP was created to encourage low and moderate income community financial institutions to augment their efforts to support small businesses and consumers in their communities. Under the ECIP program, the U.S. Treasury will provide up to $9 billion in capital directly to depository institutions that are certified community development financial institutions or minority depository institutions to provide loans, grants, and forbearance for small businesses, minority-owned businesses, and consumers, especially in the low-income and underserved communities that may be disproportionately impacted by the economic effects of the COVID-19 pandemic. For today's webinar, our primary goal is to discuss the ECIP program availability to the credit union industry. We want to provide eligible, low, and moderate income community financial institutions information on the program, which will hopefully provide you with the needed time to prepare for the application requirements. While the many details are still being worked through with Treasury, we will summarize the key provisions of the ECIP, walk through some of the key application components, and how this program interacts with the credit union's ability to count it as secondary capital. For today's agenda, we are very appreciative to have representatives from the U.S. Treasury led by Brian Donovan. Brian is the acting program lead who will provide you with a few updates on the ECIP program and also participate in the question and answer session. The U.S. Treasury is also the facilitator of this program and will post program terms, regulations, and other materials on their website and open the ECIP application portal to begin accepting applications in the near future. Following Brian, Tom Fay, Director of Capital Markets from the Office of Examination and Insurance at the NCUA, will walk you through the slides that summarize the key provisions of the ECIP program and the companion secondary capital requirements, if applicable. We will conclude today's webinar with a question and answer session. However, you may also submit questions on today's material or email the ECIP program at ecipinquiries@treasury.gov, or you also may email your NCUA regional office. I will now turn it over to Brian Donovan, Acting Program Lead for the ECIP program. Welcome, Brian.
Thank you, Myra. I'm just going to give the briefest of overviews here, and then I'll turn it over to Tom to continue onward. But I'm from the Treasury Department, and I'm helping to stand up the ECIP program. We do have a website that Myra mentioned is available and out there. The actual application itself, when it does come time to submit, will go to a portal that will be hosted on that website. And right now we have a draft application document that I believe is up on that website, and an announcement went out a couple of weeks ago when we first posted it. Currently we're working on finalizing the terms and interim final rule, or IFR, that will set out the rules for the program. I wouldn't expect that it'll be too long into the future before we post them and announce them. We do intend to publicize in various measures and media when it is actually when we go live. And we will allow what we believe is a sufficient amount of time for any entity that's interested in applying to apply to the program. And so it's not one that you will have to, we don't intend to run it as a first in, first out kind of program. So we would encourage any applicant to take their time and try to submit a thorough application when they do actually do that. The only other things that I'll just kind of mention briefly is that, it is a program for credit unions, banks, and bank holding companies. You're all lumped in together. There are a couple of buckets by asset size, one for institutions that have up to $500 million in assets. There's $2 billion of the up to $9 billion is reserved for them. And then an additional $2 billion is reserved for those that are up to $2 billion in asset sizes. So there is, if you want to call it a set aside, some money available. A decent chunk, 4 out of the $9 billion, is available for small and mid-sized financial institutions. We do have a email address that's on the slide below number 4 here. If anybody has any questions at the end of this presentation that you believe you want to direct to Treasury itself as opposed to your contacts at the NCUA, please email us at that email address. And with that, I'm going to turn it over to Tom Fay, who is the Director of Capital Markets at NCUA, and he's going to go over some of the features of the ECIP program. Tom?
Okay, thank you, Brian. And thank you, Myra, for your opening remarks. I am, for the audience of today's webinar, I am going to use, primarily I'm going to use the slides. I'm starting on slide 6. And just to reinforce a little bit what Brian was just saying is that there's still some work to be done. And NCUA is working very closely with Treasury to iron out the details. And I'll get into some of that as I go through the slides. But if we don't answer your questions today or don't have a response for some of your questions today, it's just because that some of this is still being firmed up. But we are working day to day on this program with Treasury. And so hopefully it won't be too long. We may develop, if we don't answer your questions today, it's possible we may develop some sort of Q&A as part of our COVID-19 response webpage on NCUA to provide you with that information. So you don't have to re-ask those questions if we find it critical enough to have on the Q&A. So with that, I'm going to start on slide 6, and I'm going to go right into the legislation. So obviously this is legislation that was passed back in late December, and so we have been reviewing the legislation, extracting pieces that are most important for the credit union industry, which is why we thought we'd have this session earlier than later to get you the ample time to start preparing your investment plan and any other applications required. And I'll get into some of that nuance of a dual track application. So slide 6 again. I think the program has been introduced by Myra and Brian. I won't go into the top paragraph, but I will touch first on eligibility. So eligibility is a very important aspect of this program. It's not for everyone. As the pandemic relief nature of the program, obviously the target here is to encourage low and moderate income community financial institutions, right, to augment their efforts. So that's essentially, if that's the scope, then what is the eligibility of an institution, especially of a federally insured credit institution, what is the eligibility to enter into this program? So I've highlighted 3 different steps on the bottom of slide 6 that will hopefully clear this up. Although the statute is pretty clear itself too. In section 104A, I believe it's 104A is the section in the statute. But anyway, step number 1 is, are you a community development financial institution? Or are you a minority depository institution? So the first hurdle, if you will, is essentially, do you have a designation of a CDFI or an NDI? Step 2, I apologize for the echo. Step 2, are you one of these financial institutions? And here, obviously specific to today, is, are you a federally insured credit union? And so if you've met number 1, you've met number 2, the last eligibility hurdle in order to enter this program is, are you not designated in troubled condition? And troubled condition from NCUA standpoint is promulgated in our NCUA rule 12 CFR 700.2 for credit union. So if you'd like to know what that is, you can see the regulation for trouble condition. Part 2 of that ineligibility test is, are you also not subject to any formal enforcement actions addressing unsafe or unsound lending practices? As Brian noted, the application that is in draft form on the Treasury website for this program, you can get a flavor for some of the questions and eligibility that will be part of the final application when we do finalize that with them. So you can get a sense of what they're looking for in the application now, which essentially is some of these questions over and above what's in the statute to be more clear with financial institutions on eligibility. So that's the program eligibility. In order to even think about developing an investment plan, then you would have to clear those 3 and answer those questions on the application. I'll advance to slide 7. If you do meet the eligibility test, then obviously bullet 1, to be eligible to receive a capital investment under the program, an eligible applicant must complete the Emergency Capital Investment Program application form, which is what I just referred to on Treasury's website, which is where you will pull that down, complete the application, and resubmit that back into the Treasury portal. You can see that form, and I have the link here, or at least you could paste that into your web browser if you want to see the website and the draft application. I'll get into a little bit on how process is going to work in this next bullet, but I will expand on that a little bit later in the next few slides. For each application received, Treasury will consult with and share certain application materials with FDIC, the Fed, the OCC, and of course, most important here today, NCUA. And we will work with our state supervisors on the state charter element of how we will coordinate the movement and assessment of applications. And then lastly, Brian has already alluded to this, but I'll repeat it. Responses to the Emergency Investment Program application, including the lending plan, may be used to determine investment amounts or prioritization of determinations. So I think Brian made a pretty good point about it's not first come, it's first served. There's going to be an assessment and allocation of the appropriation made for this program. Okay, let me move into the actual questions, and I will be fairly redundant in reading some of these right out of the statute, but I think it's important to do so you can, if you've read it, you're not clear about it, I'm going to read it and perhaps, ad-lib a little bit in terms of what the question is really looking to achieve. So question number 1 of the Emergency Investment Lending Plan. This is in section 104A, D, and then /4. You'll see those 4 questions. The first thing you should note with respect to question number 1 is, if you already are a CDFI designation, then you don't need to complete question number 1. You can skip to question number 2. And I'll explain that. Let me just get through the question, and then I'll make reference back to why CDFI does not need to comply with or respond to question number 1. So question number 1, again, right out of the statute, is looking for the applicant's lending made directly to LMI borrowers and to borrowers that create direct benefits for LMI populations. And that measurement takes place in 2 different forms. One is, what are the number of loans that were made or originated during the 2019 and 2020 fiscal years? And then on the right side in that table is, what is the value of those loans or total amount of the loans originated in fiscal years 19 and 20? So essentially, if you look back on the statute, it is looking for not less than 30%. And this is not an or statement, this is an and statement. So both the number of loans and the total value of those loans need to be not less than 30% of the overall lending by that eligible institution. So 2 measurements, number of loans, total value of loans made directly to LMI borrowers or to borrowers that create direct benefits to LMI populations is the essence of the first question. I'll advance to slide 9. Slide 9 is a follow-up and with a bit more specific detail to the first question. And essentially, it is for loans originated by the applicant over the past 2 years. So again, the basis of your response to the first question 1A, now we're going to use again in question 1B. So applicant over the past 2 fiscal years to borrowers that create direct benefits for LMI populations, provide in the attached workbook up to 5 of the largest of such borrowers served by the applicant. So we're looking for detail and using what were the 5 largest of such borrowers that was included in your question 1A, including county, state, number of LMI individuals that were benefited from that activity, number of loans originated to that borrower, total amount of loans, and then a description of the benefits to those LMI communities. There again, I think as part of the application, you may see another attachment that will give you the ability to populate this information. Okay, so that rounds out question number 1. And by the way, there are 4 questions in total in the application. in the ECIP application. Question number 2, again, it's all in the same section in the statute. You can see these incrementally after each other. Question number 2 is about the business strategy to address community development needs. So here, this is more of a qualitative question about the business strategy and operating goals of the applicant and how they will address the community development needs in communities that may be disproportionately impacted by the economic effects of COVID-19. So here, what we're looking for as part of the application is to provide, and I have this in italics below, provide measurable factors for how the community has been impacted by COVID-19, such as increases in unemployment, the number of businesses closed due to the pandemic, or mortgage delinquencies. Okay, and that's question number 2. There is a follow-up question to expand on the question number 2. And here we're looking for 5 examples. And so I've underlined and italicized the main points of this question. So in response to the question, also include up to 5 examples of particular business activities that the applicant will perform in fiscal years 2021 to address community development needs in communities, again, that may be disproportionately impacted by the economic effects of COVID-19. So here, a little bit more of a detailed example of how your business strategy will work. Just to follow up on that on the bottom, or actually, I'm sorry, in the middle where it says for each example, I think it's the second sentence. For each example, provide quantitative estimates and anticipated timing information that illustrate how the relevant community development needs will be met. So again, this is more in the 5 examples. If there's a quantitative estimate that would be helpful to articulate and demonstrate how those 5 examples will work, then it would be much appreciated. And following up on the bottom, each applicant should provide data and information that support its belief that business strategy and operational goals are realistic and achievable and will address the community development needs in communities that may be disproportionately impacted by COVID-19. So there you'll have an opportunity to expand on question 2A with examples. I'm going to move ahead to slide 12, which is question number 3. And I apologize for the small print. I know on my live view, I will not be able to read this, so I'm looking down at my slides, printed slides, and we apologize for that. But again, this is in the application on the Treasury website if you need to see it in your own way. Again, what we're here looking for now with question number 3 is how much. Okay, now we're talking about the substance of how much you're going to issue as part of this ECIP. And the top question in 3A is provide the additional aggregate dollar amount of loans. So over and above, or related to you accepting this investment, how much additional aggregate dollar amount of loans as a direct result of the issuing the full amount of the financial instrument as part of this program will be provided in fiscal years 2020 relative to fiscal years 21 relative to 2020. So again, how much more lending will take place to those targeted borrowers as a result of you accepting this investment? The bottom half of this question which is question 3B, is asking for not just fiscal years 2021, but fiscal year 2021 through 23. And so if you're starting with base year, which is your fiscal year 2020, what was your total volume of lending and investment So it's not necessarily to LMI borrowers. What was the total amount of lending and investment for fiscal years 2020 and projecting out your 2021 to 2023? And then below that, what was the fiscal year 2020 and projections for lending into those LMI communities or LMI communities disproportionately impacted by COVID-19. So you can see again, we're looking for that ratio, not just what you've already done in the prior 2 years as part of eligibility, but how much you're projecting to do over the next 3 years. Okay, and I'm going to advance the slide to slide 13. And this is, again, another follow-up, staying within question number 3C. And here we're looking for include details on how the applicant plans to expand or maintain significant lending or investment activity in LMI minority communities. So the response, and this is paragraph 2 on that page, the response should include quantifiable details on the applicant's planned approach to expanding or maintaining significant levels of lending or investment in these communities related to current and projected types of lending and investment. So here, this is more about how the applicant is going to do and support those projections that you referred to on question 3B. Okay, and lastly is question number 4. I'd move to slide 14. Question number 4, provide a detailed plan describing how the applicant will provide community outreach and communication where appropriate. So here again, I'm just reciting the statute. The applicant's plan for community outreach and communication may be provided or described through a community benefits agreement between the applicant and the organizations, trade associations, and individuals that represent or work within minority or LMI communities. So here, again, if there's a quantitative aspect of that to reinforce the plan, then include it. So the response should include quantitative details on how particular aspects and features of this applicant's planned community outreach and communication approach may help the applicant achieve the group's specific projected for fiscal years 2021 to 23. So this, again, is a little bit more about how the applicant is providing that community outreach and communication. So you can see how question 4 has a connection to question 3C and maybe even a little bit of question all the way back to 2B on the qualitative and insight as to how you're going to support those projections for this type of lending going forward. So those are the 4 questions that are in the draft application on the Treasury website. There may be a little bit more assistance in terms of what we're exactly looking for in those questions, but you can get a pretty good flavor for that information in the application now. So please, if you take a look at it, read it through. If there's any questions, please respond to Treasury. They have their link, and they will accept questions. Okay, so now we're by the lending plan, and now is the financial instrument. So depending on what type of entity you are, and we know today we're addressing credit unions, that the investment will be in the form of a subordinated debt note. And so subordinated debt is not a new concept for NCUA or credit unions. And so we would be utilizing some of the same procedures and some of the same material or information we know about how credit unions today issue subordinated debt. However, the terms and I'll move to slide 16, the terms will be different, of course, than as if a credit union were seeking its own subordinated debt program. So in the statute, and I'll refer to it just a couple of places in the statute on the terms. First, we know what will be the cost or the rate of that financial instrument. And the first bullet refers to it as a rate exceeding, or a rate will not exceed 2% per annum for the first 10 years. We also know that that rate, depending on the amount of increased lending to LMI borrowers, can be scaled down. And so I'll start with bullet number 1 first, is that there will be no dividends, which means there will be no cost for the first 24 months of this investment. So there's no accrual, and there's no cost, and there's no cash flows on this note for the first 2 years. The second bullet there and the third bullet toward the end shows you how this rate can scale down to either 1.25% per annum or 0.5% per annum, depending on how much of your lending as a result of this program has increased. Will it be between 200 and 400%? Then your rate scales down to 1.25. If it is increased by more than 400%, then the rate would not exceed a 0.5% rate. Moving to slide 17, there are some restrictions in terms, and this is just the limits of how much any financial institution can, or how much an investment and a Treasury can make at any financial institution. So obviously the hard line number is no more than $250 million. And then the following 3 bullets show you the maximum depending on what your total assets are. And I'm pretty sure we'll probably use December 31st as the date. It's not official, but given that we're just about closing the timeline on the submissions for credit union call reporting for the year end, it's possible we could use December 31. So essentially is that you could not issue more than 7.5% of total assets if you had total assets of $2 billion or less. And then you can see the following two bullets: no more than 15% up to $500 million in assets, but not more than $2 billion, and then not more than 22.5% of total assets for less than $500 million. So those are the limits in terms of how much you can issue. The total program, I think I have it highlighted in red on top. Obviously, Treasury was appropriated a total of $9 billion for this program. That $9 billion is for all eligible institutions, not just credit unions. And so just to make that clear. Slide 18, just a couple of more points on how the appropriation is allocated, which is what we call set-asides. And essentially $4 billion of the 9 will be made available to eligible institutions with total assets up to $2 billion. And then of that $4 billion, $2 billion of it will be made available to eligible institutions with total assets of less than $500 million. So you can see how the $9 billion is appropriated down the total asset scale of financial institutions. Okay, so what may be new to you, folks who are participating on today's webinar and not in the statute, is how will NCUA and how will Treasury process your application? Now, I know Brian alluded to this just a little bit, but I'm going to expand on it as it relates to credit unions, or at least federally insured credit unions. So number one, we know that an eligible credit union, which is the the square on the left, will retrieve the application from the Treasury website, fill it out, and send it back to the Treasury portal. So if you look at that top green arrow going all the way across back to Treasury, that is the requirement in order to enter this program. What we would prefer, in addition to that, of course, that being the minimum requirement to be eligible into this program, is we would prefer that perhaps the eligible credit union would also send that application to NCUA's regional supervision office, and if it's a state chartered credit union, also send that to your state supervisor. Now, you're not required to do those things. We're asking you as a courtesy to do those things because we don't know how many applications we're going to receive. There could be a high volume. We also are creating backups in case you don't send those. So our cure unit will ensure that whatever Treasury has received is also in the hands of NCUA and, if applicable, a state supervisor. So we'll ensure the reconciliation. However, it would be expeditious, at least if we could get those applications sent to 3 places if it's a state charter. So I'll just go down the number of points quickly. Eligible credit unions submit the ECIP application to Treasury, and then again, NCUA and the SSA would be appreciated. Number 2, Treasury acknowledges the receipt and begins the review in consultation with NCUA. So as the statute says, Treasury will consult with the primary regulator on the application for funds. Number 3, and I'll say it again, NCUA will consult with the respective SSA on the assessment of a state chartered application. So this may remind you of what we already have in place for secondary capital. As per today's rules, a state chartered credit union will submit a secondary capital application to its state supervisor. The state supervisor conducts that assessment, and then NCUA will concur if their assessment is for approval. So we don't do the initial assessment, and we're going to use that same model for the ECIP application as we look to make that final consultation with Treasury from our cure unit in NCUA. Speaking of the cure unit, all communications and the status of the application, of an ECIP application, will be managed by the cure team with the Treasury team. And I know they're agreeing on the cadence and the form of which to use to reconcile application received and the status of applications. And then lastly, Treasury will provide the eligible credit union with that determination of the capital investment. So it sort of works its way through the process, but an eligible credit union will hear from Treasury on that determination. You will not hear from NCUA, you will not hear it from a state supervisor, you will hear it from Treasury. Slide 20. And here's the nexus to our current secondary capital process. So as today, if a credit union wishes to issue subordinated debt and get secondary capital treatment, they need to provide and submit a plan to NCUA to approve. So I'll read through the 3 bullets. An eligible credit union that is applying for ECIP funds in the form of subordinated debt and also has a designation of a low-income credit union. So here's the third, and I don't know if it's a third, but are you a CDFI? Are you an MDI? Are you a federally insured credit union? Are you not in troubled condition? And are you a like-Q? Not all of those things are synonymous or congruent with each other. So again, if you are like you're submitting an application, then you also can receive secondary capital treatment for that issuance. And so I'll finish the sentence, may submit a secondary capital plan as per NCUA Part 70134 to recognize the ECIP amount as net worth. Now, as you may recall, in our December board meeting, we did finalize a new, or I should say, revised subordinated debt rule. However, that subordinated debt rule is not effective until January 2022. So therefore, any issuance up until January 1st, 2022 is still subject to the current 70134 rules. Bullet 2, the submission of the secondary capital plan application is separate from the ECIP application. So do not send two applications to Treasury, and I'll get into it in the next slide. Only send the ECIP application to Treasury. That is part one of these, what I call a dual track process. Lastly, the application and approval process for secondary capital will utilize the current NCUA/SSA processes for assessment and approval/concurrence. So if you're already familiar with that process, then we will be utilizing the same exact thing. And when I refer to NCUA, what I really mean is the Regional Supervision Office. So today, when you send those plans today, you send it to the regional director of that region. Again, this is the same exact process for either the ECIP and for the if there's a company secondary capital plan. Okay, slide 21 is then the companion to the ECIP application. If you are eligible for ECIP, you also are like you wish to get secondary capital treatment for your ECIP issuance, then you will also have to prepare a secondary capital plan and submit that to the Regional Supervision Office for approval. As you can see by the green arrows, they would get submitted as they do today to the state supervisor and or the Regional Supervision Office of NCUA. And also, similar to today, you will receive notification from the state supervisor upon approval with NCUA's concurrence, or if you're a federal credit union, you will receive that same determination from NCUA. We also are going to use the, as part of 70134, the maximum time to do this. So again, in our current regulation, timeline not to exceed 45 days or will be automatically approved. Of course, we know that this is already a very important application. We also know as part of the ECIP program, we will do our best to meet or at least do better than the 45 days to inform you of our decision on that secondary capital plan. We also know that the ECIP determination by Treasury, if you are seeking capital treatment, you may receive a determination from Treasury. However, it also may indicate that it's pending NCUA's determination on the secondary capital plan. So here we're trying to synchronize these two processes as best we can to be as efficient as possible to the applicant, so you know, hopefully, as soon as possible, your determination of ECIP and your determination on whether you have a secondary capital approval. So we're going to do our best to keep those as tight as possible and keep you informed. Okay, I'm going to advance to slide 22. I promise I'm only one slide or two slides away before we get into Q&A. Okay, I think I've alluded to some of this, but what are the considerations of a dual application process? Okay, it's not lost on us that the ECIP program is a very interesting and beneficial program, given the pandemic relief nature of it. But also, it's not lost on us that this activity also provides you with the ability to count it as capital/net worth. But however, as you know, we have a current approval process in place, and so we cannot bypass that. We cannot expedite that any differently than we have for any secondary capital application. So I think I probably mentioned these bullets differently in some ways, but I'll go through them quickly. In order to achieve the desired goal of the ECIP program, NCUA is asking eligible credit unions to submit their secondary capital applications no later than 2 weeks after their submission of the ECIP application. Now, this is not a regulation. You're not bound in terms of when you send your secondary capital application and any rules when you send that. But as a courtesy, and because the two are linked, we do want to keep this program as efficient as possible in getting back to you on any of the decisions. And we realize, though, that the amount of effort that you have to put into both is probably significant. So we're asking you to submit your ECIP program application, and then please, no later than 2 weeks after that application, if you could please submit your secondary capital application. That hopefully keeps the program in its entirety of no more than maybe 60 days in terms of any determination you would receive. Bullet 2, NCUA and the respective SSAs, if applicable, will complete the reviews of secondary capital within 45 days. Number 3, Treasury may render a decision on the ECIP to the applicant ahead of the pending secondary capital decision. A credit union who receives that determination may still want to know if they're going to get secondary capital before they finalize that agreement with Treasury. You will have that decision point to make and then decide whether you want to continue, even if you are denied secondary capital, or you will wait until you hear from NCUA on that determination. So I've said a lot. There's a lot to consider here, and I've noticed that we've got tons of questions, and I want to stop so I can get to some of those. There are other items in the ECIP program. I won't get into the details, but they're in the statute. We may expand on those in the Q&A, but there are payment contingencies based on certain financial conditions. There is restrictions on executive comp and dividend payments, restrictions on conflict of interest, and then lastly, post the settlement of any issuance that you have with this program will be monitored by Treasury through their Inspector General and through the Secretary of Treasury on the efficacy and the usefulness of the program. So contact information, I think Brian made reference to this. If you have any questions about the ECIP program, please send them to Treasury. Any questions on how the secondary capital part of this is, about secondary capital part of this, please send that to your regional supervision office. And that is my part of the presentation. I'm going to hand it back over to Catherine. Thank you, everyone.
Okay, thank you, Tom. We do have a whole slew of questions. I'm going to move us on into the Q&A. Everyone, if you, the information that we have in our resources, there's a resources widget on your console. So you'll have access to the slides and also web links to give you more information on this program. So please go there and download those links and so forth. Also, we do have a survey that we'd like you to fill out really quickly while we go through our Q&A. And so you can use the that widget as well, a survey widget for that. So we don't have that much time to go, so we're going to give our guests from Treasury. Brian, are you there? We have quite a few questions for you.
I bet you do. I am here.
Okay, great. Here's one credit union. So here's what one credit union said. they want to know if the ECIP application purely a yes or no decision, or will the Treasury approve lower or higher amounts than requested by a credit union? Great question.
It is. I don't think we would approve for a higher amount than what you asked for. There is a chance that we may approve for a lower amount.
Okay, great. All righty. So let's ask another question from a credit union. So this credit union wants to know what the target dates are that are being considered as far as the application deadline, the ECIP application deadline.
So I think once we launch it, that'll start the clock, and roughly, I mean, it's hard to say exactly how long it'll be. It'll be more than a month that it'll be open, perhaps 2 months or so will be the time period to apply. That's what we're going with right now, but the clock will start on whatever day we launch the program.
Okay, great. All righty. Now, also, I wanted to let everyone know that the individuals that we have here on our Q&A, we have Brian Donovan, who's from the Treasury Department. We also have Justin Anderson, who is from NCUA, from the General Counsel's Office. We have Pam Williams, who's from CURE, who's in the MDI, and Ikena, who is with also with CURE. And we have Jean Marie Comiathi. So let me ask you one more question, Brian, and then we're going to ask our other panelists some questions. We've got quite a few for you. And I think I already asked that one. So here's a question. They said the rate ranges from 0.5 to 2%. Does the interest accrue from the origin of the note or after the 2 years is the question.
I believe we're going to start the accrual clock on the 2-year anniversary of the day you actually close on the note.
Okay, that's a good one. All right, let's do one more for you, Brian. Let's see. So here's a question. For the emergency investment lending plan, the credit union says, does the fiscal year mean January to December of the year, as in fiscal year 2021, or how is it calculated?
We will issue probably a little further guidance. I know some CDFIs from my past experience use a different fiscal year than the calendar year. I believe we will go with, we will take that under advisement. It's likely we will go with the institution's fiscal year, but we will provide further guidance on that. That is a question we realize we need to address.
Okay, awesome. I'm going to introduce Jean Marie Comiathi. She's the Deputy Director of the Office of Credit Union Resources and Expansion. Jean Marie, you have some questions that you'd like to ask our panel.
I do. Thank you, everyone. So I'd like to pass this question to Tom. I know you mentioned this in the presentation, but several credit unions have asked where they should be submitting their information to NCUA.
Thanks, Jean Marie. Yeah, so I think I may have mentioned it, but please send your secondary capital application to the regional supervision office. So you already you may already have had or you have your contacts at your regional director's office, and so that secondary capital, any secondary capital application should be sent to the regional office. Again, the ECIP application goes right back to the Treasury's portal when you load that document back.
Okay, thank you. Another question for you, Tom. Would the secondary capital plan have to specify that the funding will occur through the ECIP, or can an existing approval use ECIP funds even if it was not identified in the already approved secondary capital plan?
Great question. The way I would go about producing a secondary capital plan is use the amount that you have applied for as part of the ECIP. I know Brian mentioned it may be that amount or lower. I don't think it'll be higher. but use that amount as part of your application, because that's the only information that the credit union knows, and it's the only information that the application and its companion secondary capital application. Of course, if it comes determination comes back and it's lower, then they should communicate that back to the regional office that the amount is lower, and please consider this as part of the application. Or they may have to resubmit that secondary capital application just to change those amounts and those pro forma forecasting.
Okay. And then one last question about the secondary capital plans. Does a credit union have to wait to get a determination from Treasury before submitting their secondary capital plan, or should they submit the secondary capital plan application at the same time they submit the ECIP application?
Good question. I think the best way to handle this, and I made reference to this, is that after you send your ECIP application, and you no more than 2 weeks after that, if you would please send your secondary capital application. If, again, you'll qualify, you're like you, and you're seeking net worth treatment, I would not wait more than 2 weeks to send your application into your regional supervision office. This gives us the opportunity to efficiently review all of this together, provide you with determination, instead of you receiving a determination and then it takes you another 45 days to find out if you're going to get net worth treatment for that. Thanks.
Okay, thank you.
Okay, we have time for one last question, so I want to give this to Brian Donovan. And we will post the answers to the questions that came in our Learning Management Service when we post the webinar. So Brian, are you still there?
I am.
Okay, great. So here's what one credit union asked. They said, will the loan plan be reviewed by both the NCUA and the Treasury?
I think that's correct. We'll be soliciting feedback for credit unions from the NCUA on what they think about the plan, but we'll also be doing a separate review of it ourselves.
Okay. All righty. Thank you very much. And before we go, let's get a question to the CURE team, if we can. Get another question there. So here's a question. I don't know if we already asked this, the CURE team. May a credit union that is not currently a CDFI MDI become one if they qualify for one of these designations and then participate in the ECIP? Anybody?
Catherine, this is Jean Marie, and I'll be happy to answer that one.
Great.
It is our understanding that the program will look at your designation as of December 31st, 2020. So you need to have been designated as a CDFI or self-certified as an MDI as of that date.
Fantastic. Well, everyone, I think, unfortunately, we're fresh out of time, but we are going to have all of these questions that we received answered, and we'll have a transcript of the answers, questions and answers, placed in our Learning Management Service along with the webinar when it's posted. Thank you so much for joining us. We'd like to thank everyone from the Treasury Department for joining us today, and thank all of our CURE staff, Myra Tepe, and also Tom Fay, and Justin Anderson from OGC. Thanks, everyone, and thanks to Franz Ayento, who helps us with all of our technology, and also Grace from On24. Everyone, have a great afternoon, and have a wonderful rest of the week.